Ladies and gents, traders and investors, a very warm welcome to our channel Polo Vega. On today's video, we shall be exploring the activities in different markets around the world, and we shall discontinue with the discussion of our option strategies that we had been doing for the past couple of weeks. From next week onwards, we shall be exploring a new market, which is going to be the National Stock Exchange of India, the index-based options, and the scripts listed on the National Stock Exchange of India. The exchange has done very well since establishment in the late 90s and is now one of the most heavily traded exchanges of India, and we shall look into the volume of trading, the advantages of trading the Indian market, and many other activities that have been encouraged by the Stock Exchange of India, the regulations, and other factors that have been strengthened to strengthen the market. On today's video, we shall be looking at DXY, the US dollar based index, NQ, the Nasdaq based ETF, ES, the S&P 500 based ETF, XAU/USD, the gold based ETF, XAG/USD, the silver based ETF, NIFTY, the National Stock Exchange of India's index, and finally the US oil spot market, which is currently governing all trades around the world because of its movement controlling the US dollar. Disclaimer/disclosure. The presentation is the 54th of a series of interactive videos aimed at educating our viewers, and we'd like to warn all our viewers of the risk associated with the business of trading and investment. Securities investment and trading is a highly risky business where there exists a possibility of partial or total loss of investment. The ideas and opinions in our video are solely based on our analysis of the market, and we do not advise, recommend, guide anyone to take any trade based on the contents of this video, and we do not take any responsibility for the partial/total losses arising out of trades based on the contents of this video. The chart on our screen is that of DXY, the US dollar index, and we're looking at the daily chart. DXY has been trading in a range-bound condition between 99.25 and 99.80 on the upper side. As indicated earlier, that if the situation in the Middle East and the war between the US and Iran comes to a deal-making condition, then the price of oil should go down, and that should bring the DXY or the US dollar to a lower level. And because of the events of last week, there seems to be an improvement in the conditions in the Middle East, and that has led to this red candle on Friday, which has taken out all the gains from the previous days. So therefore, we could look at taking out the demand at 99.25 and then going further down to the next demand level, which is at 98.664. But until then, we shall be looking at taking sell trades only and no buy trades for the US dollar index. We now come to NQ, the Nasdaq based ETF, and we're looking at the daily chart. Nasdaq has had a very good run on Monday and Tuesday, followed by a marginal drop, and then again coming back to where it started from at the end of the week. It still hasn't been able to take out the supply at 30065.93, one of the highs from May and June this year. So therefore, we still have to wait and see if we can manage to break above this 30065 at the back of the situation improving at the Middle East, and with all the expectations now hovering around the opening of the Strait of Hormuz sometime next week. We therefore should still be bullish, and our best trade shall be at the demand zone 29.371 and 29.122. That's the zone that we're looking at, and if it manages to come back into this zone, we could still try to go long and expect to go all the way above 30065.93 onto the next supply zone, which is between 30538.29 and 31108.86. So that's the supply zone or the target area, and the entry zone or the demand zone is between 29.371 and 29.122. We now come to the best performing index of last week, and it is ES, the S&P 500 based ETF, and we're looking at the daily chart. ES printed some very good candles on Monday and Tuesday of last week, and finally on Wednesday it touched its all-time high at 7827.03, while printing its explosive rally candles on Monday and Tuesday. It broke out above its highs at 787.35 and 7688.18, and finally it closed at 779.95. It's 779.75 when it closed on Friday, and we now have to look at its return to any of the lower time frame demand zones in order to continue with the bullish run and take an advantage of the strength and the momentum of the bulls in this market. So the best zone that we can see as of now is at 7726.69 and 7739.07. So that's the demand zone that we're looking at the moment, although there could be a chance that the supply at 7767.95 and 7748.15 could become the next demand zone if the rally continues upwards on Monday and tries to break above its all-time high at 7827.03 and close to make a new high at some higher level. In that case, we could be going long at 7771.25 with a stop loss below 7744.02. We now looking at the 240-minute chart, but we could also look at the 60-minute chart to see if there are other options of getting into a long on this particular index. As we said, it is the best performing index and it has managed to print a new high, and the bulls are in total control of the index as we speak. So there's nothing even on the 60-minute time zone. So for us, the best zone to enter for going long is at the decided zone on at between 7736.59 and 7725.87. So that's the best area to go long, and we have to wait and see as to what happens on Monday, whether it comes down into our intended demand zone or whether it goes back up, and then we have to choose a new demand zone to get into a long. The chart on our screen is that of NIFTY. the National Stock Exchange India's index, and we're looking at the daily chart. Nifty has been hovering around the 24600 area, which has been acting as a very strong resistance for the last 6 months. It last traded above this area in the month of March 2026, and now it's again trying to break above this area, and one needs to wait and see because it has been trading in dojis only for the last couple of weeks, and there has been no explosive moves except for the gap up on Monday of last week. That's the gap up we can see, which is from 24,390, 24,400 all the way to 24,600, and there was a chance that it tried to break above, where it closed at 24,750 on Tuesday, and then on it has been trading in dojis. Also, we can see that there has been a reduction in volume of trading on the National Stock Exchange of India, as we can see whether it's the greens or the reds. So both the sellers and buyers seem to have moved out of the National Stock Exchange of India, and that's purely because of the exit of the foreign traders in the Indian market, and that has also led to the weakening of the Indian rupee against its forex majors. One needs to see that the rupee can gain its strength in future and also can lead to the strengthening of the Indian stock markets. The chart on our screen is the XAU/USD, the gold based ETF, and we're looking at the daily chart. As we can see, that gold had been squeezing into a triangular channel up until the beginning of last week, when it managed to break out with an explosive candle printed on Wednesday, which touched 4271 and finally closed at 4248 to break out above the controlling supply zone between 4203 and 4167. So there was a controlling area that had been holding the bulls from breaking above, and that was the zone that was maintaining the downtrend in the metal. Gold then managed to print a doji on Thursday and then printed another big rally on Friday to come into the next supply zone between 4297 and 4389. So that's the zone that it's currently trading in, encountering the sell orders left behind in this area, and we shall need to wait and see if it can take out all the sell orders in this area and go into the next supply zone between 4444.5 and 4574. So that's the next seller zone that it has to encounter, and if it manages, or if it doesn't manage to break above the current supply zone, and if it drops below, then there's a nice support area formed last week, which is between 4222 and 4252. So that's the immediate demand zone that has got buy orders to take on the sellers from the area above. But if it manages to break below this demand zone, then there's another very good area for the bulls to get into a long, and that is the area between 4010 and 4069. So that's the demand area that one needs to look out for if at all somebody is looking at getting into a short on the metal, because it has been in a downtrend and the overall picture is still now very bullish. So both the bulls as well as the bears need to be careful when taking their positions and must back up their positions with tight stop losses. The chart on our screen is the FXAG/USD, and we're looking at the daily chart. Silver, unlike gold, hasn't been as strong during last week, but it has managed to close above its supply zone between 63.07 and 61.41, which was the immediate supply zone above the recent demand zone that was formed in July this year. But that's the controlling candle as of now, which has been supporting the buyers and has been holding the metal steadily above 54.25. So that's the low that silver has touched so far, and it has been trading sideways with a bit of strength shown last week because of the fall in the US dollar and the fall in the price of oil and the expectations of the opening of the Strait of Hormuz anytime soon. So all of these factors have led into the weakening of the dollar and the strengthening of the metals on the back of the weak US dollar. But unlike gold, silver hasn't managed to gather all the momentum that has been given by the weakening dollar, and one needs to be careful in going for a long if at all one wants to get into a long, or even for a short one needs to be very careful because the metal has just been trading sideways and one doesn't know if it again starts trading in the same range, which is between 55 and between 64. So that's the range that silver could be trading in if it doesn't find any strength or any weakness from the geopolitical or the economic news that comes out next week. The chart on our screen is that of US oil spot, and we're looking at the daily chart. US oil spot has got a very important role in today's market because the price of oil is controlling the price of every commodity being bought or sold in the global market. Why? Because of the reason that the price of oil currently is controlling the movement of the US dollar, so it's indirectly controlling the price of every commodity being bought or sold in the global economy. Gold has moved up last week, silver has moved last week because of a fall in the price of US oil on the expectation of the opening of the Strait of Hormuz anytime soon. The bears have managed to gain some control in the market during last week with two consecutive drops on Monday and Tuesday, followed by a doji on Wednesday, then a rally on Thursday, and a small drop on Friday. Therefore, one needs to wait and see if it can manage to drop all the way down to its price of 65, where it was trading before the war between the United States of America and Iran started. We still are a long way from that particular price, but we need to see if the bulls can lose control anytime soon. As we can see, there are consecutive demand zones one after the other on the time chart. If it manages to break below the demand zone between 73.2 and 74.65, then there is an immediate demand zone between 71.76 and 70.8, and then another one between 68.97 and 67.0, which is the lowest low of US oil spot after the beginning of the war. So that's the low it has managed to touch in the beginning of July, but then it managed to go back up again, and then it has now come down to 73, and one needs to wait and see if oil continues to go down during the next week under the expectation of the opening of the Strait of Hormuz and a clear passage for all vessels plying through that area. Thriving in uncertainty is what we do at Polo Vega. We trade volatile markets, but we trade with absolute safety. We preserve capital at all times while we trade any kind of market. We now come to the end of our video presentation. We hope you liked our presentation and found it informative and exciting enough for you to come back and watch all our videos. If you liked our video, please hit the bell icon and subscribe to our channel Polo Vega. We thank you for watching our video, and please like, share and subscribe to our channel Polo Vega. You may also visit us at our website www.polovega.com or get in touch with us at Twitter at Polo Vega, and you may write to us at vega@polovega.com.